This is Agriculture Today, and I'm Shelby Varner with the K-State Radio Network. K-State and Washburn law professor Roger McEowen kicks off today's show as he discusses how the Research and Development Tax Credit has changed with the One Big Beautiful Bill Act. Keeping the show rolling is K-State's Rodrigo Onofre and Kansas Grain Sorghum's Maddy Meier as they preview the upcoming Sorghum Connection field days and what they'll be sharing with growers. Brad White, Bob Larson, and Phillip Lancaster from the Beef Cattle Institute in the show with part of their Cattle Chat podcast, where they explain why they encourage breeding heifers earlier than cows. That and more is coming up ahead. You're tuned in to Agriculture Today, and we start our Wednesday show talking with K-State and Washburn law professor Roger McEowen. Roger, thanks for joining us today.
Good to be with you, Shelby.
Roger, today, talking about a blog article you recently put out that discusses research and development expenses and how they have changed with the One Big Beautiful Bill Act. But before we talk about how they've changed, what were they originally under the Tax Cuts and Jobs Act?
Well, we need to actually go back before the Tax Cuts and Jobs Act, because the Tax Cuts and Jobs Act made a significant change with respect to how we handle the tax treatment of research and development, the research and experimental expenditures that feed into the research and development tax credit. Before TCJA took effect on this provision starting in 2022, a business that was incurring research and experimental expenditures could currently deduct those, and that meant quite a big deal for purposes of the R&D tax credit. You didn't have to amortize those or capitalize those and amortize them over 5 years, which is what happened under TCJA. So effective for years beginning after 2021, you didn't get as big of an upfront deduction on your return or credit on your return as you did, before this TCJA provision took effect.
So what has changed now with the One Big Beautiful Bill Act?
Well, we've kind of gone back to where we were before TCJA changed the rules, again, starting in 2022. And so we get upfront deduction of research and experimental expenditures that feed into the R&D tax credit. So that's a big deal. We don't have to expense these expenditures anymore. We get a current deduction with a twist.
Can people apply things retroactively?
Yeah, that's the twist in this whole thing. The One Big Beautiful Bill Act allows certain businesses to make an election to apply the new rule retroactively to research and experimental expenses that are paid or incurred in tax years beginning after 21. So you can go back and get your expenses in 22, 23, and 24 if you qualify, and if you make an election. So you got to do those two things. What I mean by if you qualify is you have to be a small business that meets a specific test. And most of our Kansas operations are going to qualify for this because the test is defined as having average annual gross receipts of $31 million or less for the 3 tax years preceding the year in question. So that's your threshold that is used, and that's based on some other rules that are used for other portions of the code.
What are things that qualify for the Research and Development Tax Credit?
Well, if I'm going out and I'm experimenting, trying to reduce my fertilizer expense, I'm doing some experimentations with some new cover crops, maybe a no-till planting system, these planting techniques, or I'm custom designing equipment modifications, or I'm doing extensive testing with respect to soil and nutrient levels. That can all qualify. Now, there's really a lot of elements to this. It has to be a process of experimentation, and really you need to treat it like you're working in a lab as you're designing these things. But all my costs that go into that type of a process, such as if I have employees, the wages that I pay them, my input cost for getting seed fertilizer that I'm testing, whatever it might be, parts, for example, those are what are called research and experimental expenditures, and then you plug those into a formula, and you're able to get an R&D tax credit. So actually, there can be a lot of things that farmers do that can potentially qualify for this, but you have to do it in a certain way to be able to have those expenditures qualify.
Roger, do you have an example of how things have changed from the Tax Cuts and Jobs Act to the One Big Beautiful Bill when it comes to this tax?
Well, in my blog article, I walk through a sample farm, and I set them up and say, well, let's say their average gross receipts are $25 million, so they're clearly under the $31 million, and they had taxable income for 22, 23, and 24 before you take into effect the research and experimental expenditures and credits of, let's say, $2 million in 2022, $2.1 million in 2023, and $2.2 million in 2024. Now, see, those are the ones they weren't able to claim under TCJA. They've had to capitalize those and recover those over a period of time. And let's say that they're qualified research expenditures, those are known as QREs. They paid $100,000 in 22 for labor, supplies, testing, contractor fees, and then that was $120,000 the next year, and then last year it was $130,000. Well, when you do your credit calculation, what they're going to come up with is what I show, and I'll skip the math here. You get a $10,000 credit in 22, $12,000 credit in 23, and a $13,000 credit in 2024. Now that's a credit, so that comes dollar for dollar off of the tax liability. Now, before the One Big Beautiful Bill Act, what the law required, TCJA required, was these qualified research expenditures. Again, that's the $100,000, for example, in 22 for labor and supplies and testing and all that stuff. That had to be amortized over a 5-year period. So you didn't get the $100,000 deduction up front. You had to spread that out. So you go back and you file an amended return. So that's what you have to do in these situations. You have to file an amended return for 22, amended return for 23, and another amended return for 2024. And it's going to reduce tax liability, like I said, by the amount of the credit each year. And that's going to total up to $10,000 the first year, $12,000 the second year, and $13,000 the third year. So you're getting, in my example, the individual's recovering is reducing tax liability by virtue of those amended returns by $35,000. So it's worth it if you've got a lot of expenditures. And again, I've got a farm that is incurring over $100,000 of qualified research expenditures each year. Now, if you cut that in half, you're going to cut your credit way down too. So I'd say for the larger farming operations that do qualified research and incur qualified expenditures, it's probably worth it to have your returns amended to go back and grab this.
There are a lot of intricacies with this tax credit, but what is something that you'd really like to share with our farmers and ranchers, or really anyone that this could be impacting?
Well, this is one area that, unfortunately, the promoters of the R&D tax credit have really pushed hard, and they've gone over the line, and some have been investigated by IRS Criminal Investigation Division. And the technique, the R&D tax credit, the promoters have actually caused it to end up on the IRS Dirty Dozen tax scam list. So you got to be careful. It is a legitimate technique. This is nice, what Congress just did in the One Big Beautiful Bill Act, to allow current deductibility of your expenses, and that's going to boost the credit and the ability to go back and retroactively file these amended returns and grab this. But you got to be careful. I'm already aware that the promoters are contacting farmers. They're pushing this. CPAs have contacted me from all over the country saying, what should we be doing here? Well, there's a push on, because if you're going to file an amended return, you have to have all of those amended returns done by July 4 of next year. So, farmers are going to be pushed on this, but they need to go to their tax counsel, their CPA, their tax professional, whoever it is that they work with on this, and make sure that what they're doing actually qualifies. The expenses that they're incurring are qualified expenses.
And we obviously usually focus on people involved in agriculture here, Roger, but is this for anyone who owns a small business?
Yeah, it's for any qualified business. So $31 million average gross receipts over the previous 3 years. But this does have a lot of application at farmers and ranchers. So it's not just an agricultural related provision. It's for all types of businesses that do this qualified research.
What are some key characteristics that you've seen for people who have ill intentions and are a promoter?
As applied to agriculture, what I would say there is that some of the promotion seems to indicate that they can do random sampling. There are some recent tax court cases that indicate no, promoters do not win those types of arguments. You've got to have a process, a scientific process for what you're doing. The other point I would say is to make sure that farmers understand that their entire farm is not their laboratory. You can have a sample plot, a research plot, a test area. You can have a lab inside your barn where you're testing things. But you're not going to get all of your expenses associated with your entire farm to count as qualified research expenses. Those seem to be the big ones. You remember, you got to meet a 4-part test. Your expenses, your activities have to be technological in nature. They have to resolve technical uncertainty. There has to be a process of experimentation. And you have to have a new or improved business component. And you got to document all of this. That's where promoters, I think, get a little bit get loose with this. They tend to gloss over those details. And those details are actually the core of the requirements to being able to claim the credit.
What is your key piece of advice then for farmers and ranchers avoiding these promoters or not getting caught up in their scam?
A couple of things here. I think a farm taxpayer should be really cautious of any promoter that doesn't ask for detailed information about the farmer's specific experimental activities and the technical uncertainties that they face, or what is their process of experimentation. That's what you have to have. And again, if a promoter is not asking for that information and is glossing over these requirements, then you're probably just dealing with claims for common farming practices that don't involve a true process of experimentation, and that's a big red flag.
Roger, I appreciate you taking the time to join us today.
My pleasure, Shelby.
That was K-State and Washburn law professor Roger McEowen. I will link his blog article, The OBBBA Research and Development Expenses, in today's show notes on agtoday.net. We're cutting to a short break now, but we'll be right back. You're tuned in to Agriculture Today, and we continue our show talking about the upcoming 2025 Sorghum Connection Field Days with K-State row crop plant pathologist Rodrigo Onofre and Kansas Grain Sorghum's Director of Communications and Outreach, Maddy Meier. Rodrigo, Maddy, thank you both so much for taking the time to join us today.
Yeah, thank you. I'm glad to be here.
Thank you for the invite.
For these field days, what are they?
Yeah, so we're bringing back Sorghum Connection Field Days for year 2, and we're really excited to be hosting them across central and western Kansas here at the end of August. And so these events will focus on applied research and technology, which Rodrigo will get into here in a bit, essentially for improved sorghum production across Kansas, right? And so these will include a variety of items here, but most importantly, the series is a joint effort between the Kansas Grain Sorghum Commission, K-State Research and Extension, and the K-State Department of Plant Pathology.
The summer field days for me is pretty much a moment for us to stop and look at the crop while it's still here, right? So it's an exciting time where producers can come and see all this cool and exciting research that's being done in their backyard. And it's a very applied research, right? So we're doing things that can be applied, for example, next year if it shows that it works, right?
And with that cool and exciting research that you mentioned, what is it?
So we have a variety of things. We're starting with fertility. We're doing a phosphorus rate, starting from 0 and going up to 120, which is, of course, a lot, right? But we want to find what's the optimum rate. But it's not just looking at phosphorus, but also we're doing this in combination, alone and in combination with a seed treatment from BSF. So the producers will have a chance to look at those trials, look at the different rates alone or in combination with the seed treatment. And the main idea here is perhaps we can boost the plant health through a higher fertility, but as well put that seed treatment to protect against that stalk rot later in the season, right? And the standability, of course. Another treatment that we have here It's a seed treatment trial. And again, this is a chemical seed treatment trial. We have the check, the base alone, base plus Ilevo, base plus Saltro, base plus Relina, and base plus Xyway. Everything either through a seed treatment or applied at planting. Yes, that's right. Ilevo, Saltro, they're very well used in soybeans. And now we're trying to bring some of this technology to sorghum to, again, battle some of the stalk rot and lodging at the end of the season. So we're investigating right now, looking to the possibility to see if this one, of course, will bump the yield and pay off, but as well reduce the stalk rot. Another seed treatment trial that we have, which is an exciting component too, is a biological. We have several products that are already used in other crops, and we're doing that alone or in combination with a product from BASF Relina, which is a seed treatment that's already out there. So we're trying to see, again, what's the use of biological in sorghum, right? And that, again, will be in combination with a chemical too. We have a foliar treatment trial, which several products, kind of like a shootout trial where we have several products from different companies. We're going to be looking at beginning of flower to see one yield response, but again, stalk rot impact in the end of the season, right? From our data from last year, it's quite exciting because we're seeing a yield benefit from some of these products, and we saw up to 8 bushels per acre for some of the products that we tested last year. So I think there's a lot for producers to see during these field days. And the last trial, but not least, is a cropping system that involves population and row spacing. We're varying from 25,000 to up to 80,000 seeds per acre in 2 row spacing, right? At 15 and 30-inch row spacing. So again, like producers, it's a time to come to those fields and check all this exciting research that's being done near you.
Will there also be some technology at the field day?
Oh, absolutely. We're Deepak Josh. He's our precision ag specialist, and Deepak is bringing several drones where producers will be able to see it and play with it too here, and will be mainly focused on spray application for fungicide, insecticide. Does it fit to my farm, right? I think that's one of the questions that I have. And mapping as well, mapping and surveillance, right? How can we use drones that's so ready available these days in our operation? So again, there will be some demo for that too.
What are you hoping participants get from this event?
Producers that are going to be coming to these summer field days, right? I think there's a lot of technology, a lot of research that's being done here in their backyard. And I hope they can go back and implement something that they saw here that will help them to maximize yield and their productivity, right? So if I can hit at least one of them, I'll be very happy. But as well, just to have that opportunity to see the plot results, to see it in action in the field, right? I think that's sometimes it speaks more than data in a paper at the end of the season.
Who else will be speaking at these events?
Each event will feature a mix of both university researchers and on-the-ground agronomists. And so these speakers will include Rodrigo Onofre here, Deepak Joshi from K-State, Sarah Sexton-Bowser from the Center for Sorghum Improvement, Adam York from the Kansas Grain Sorghum Commission, and agronomists Tina Sullivan and Logan Simon. And really, these are data-driven sessions, as Rodrigo mentioned, designed to better support production decisions ahead of 2026 planning. And so really excited to bring that information to the field in the backyard of sorghum country.
And Maddy, from the perspective of Kansas Grain Sorghum, what are you hoping attendees get from the events?
I think that this is a really valuable opportunity to be able to network, learn, ask questions, and see what's working out in the field, and being able to grab all of this information about this technology firsthand and to really see all of these up-and-coming items that can really advance the sorghum industry.
If someone's interested in one of these Sorghum Connection field days, when and where are they taking place?
All of these events will begin at 10 a.m. on each day, starting with the Bavaria Field Day on August 27th, and we will host it with producer Alex Bacon. And then the Russell Field Day is up next on August 28th, hosted with producer Michael Omstitz. And finally, last but not least, we have the Dighton Field Day on August 29th, hosted with producer Andy Heineman, who also serves on the association board. And each event will wrap up with lunch. Registration is free, but we do ask producers to RSVP at our website. That's ksgrainsorghum.org/sorghum-connection, so we can plan accordingly. And of course, I'd like to thank the team of extension agents here on the Sorghum Connection team. We've got Jay Wisby, Craig Dinkle, and Lacey Nonerman, a fantastic team who are helping us put together these field day series. We had 250 growers join us last year, and we're hoping to top that number this year. So again, those dates are August 27th through 29th, and we'll see you in the field.
Rodrigo, Maddy, I appreciate you both taking the time to join us today.
Thank you.
Thanks, Shelby.
That was Kansas Grain Sorghum's Director of Communications and Outreach, Maddy Meier, and she was joined by K-State row crop plant pathologist Rodrigo Onofre as they discussed the 2025 Sorghum Connection Field Days. The first one is taking place in Bavaria on August 27th, and then on August 28th, they're in Russell, and they round out on August 29th in Dighton. You can find out more information about these field days by checking out the recent agronomy e-update at eupdate.agronomy.ksu.edu, or you can go to Kansas Grain Sorghum's website, which is ksgrainsorghum.org. I will link all this in today's show notes on agtoday.net. Before we cut to a break, we're now going to be joined by USDA's Rod Bain and Lance Honig of the National Agricultural Statistics Service.
We're trying to cover really everything that the name implies.
Lance Honig of USDA's National Agricultural Statistics Service, referring to the annual Farm Production Expenditures Report.
What are farmers and ranchers spending on an ongoing basis to make their operations work? Inputs into livestock or crop-related operations, rent, fuel costs, seed costs, livestock feed, and everything in between.
The latest edition of the report, issued in late July, covered the 2024 calendar year. Among the findings,
total farm production expenditures totaled $477.6 billion for 2024. That was actually down $4.3 billion, or just shy of 1% from 2023.
Yet Honig notes that year-over-year decrease is significant in that
actually represents the first year-to-year decline we've seen since 2018.
Further breakdown of the Farm Production Expenditures Report includes top categories of expenditures.
Number one is feed costs, followed by farm services, labor, and livestock, poultry, and other related expenses.
And crop and livestock production expenditures.
Crop farm expenditures only down 0.1% year over year, while livestock farm expenditures down 1.8%. So definitely seeing a little bit bigger decline on the livestock side than what we see on the crop side for 2024.
As for a regional and state perspective,
in general, the largest contribution to these expenditures remains in the Midwest region, about 31.2% of those total expenses, followed by the Plains, the West, the Atlantic, and South. And if we break it down even further and look state by state, California continues to lead the way in terms of total expenditures, about $48.6 billion in California, followed closely by Iowa, Nebraska, Texas, and Minnesota, rounding out the top five.
I'm Rod Bain reporting for the U.S. Department of Agriculture in Washington, D.C.
We're cutting to a short break now on Agriculture Today, but stick around because we have more for you up ahead. You're tuned back into Agriculture Today, and we conclude our Wednesday show with part of the Beef Cattle Institute's Cattle Chat podcast with Brad White, Bob Larson, and Phillip Lancaster.
We often say, breed the heifers to calve before the cows. And before we get into details, I want to pin you guys down. When you say that, specifically what do you mean? And I'm going to ask it in this way. How soon should I start the breeding season for the heifers relative to the cows?
I'm going to say 30.
30 days. Phillip?
I'm going to say at least 21, because you're wanting to get a cycle in before you start the mature cows. So you get one cycle of chance to get them bred, because when they rebreed, they're usually a little bit slower to come into estrus again. And so I want that extra cycle the next year.
And the timing to come into estrus would be that postpartum or post-calving interval. And in heifers, we would think on average that may be 90 to 100 days. On cows, it's 60 to 70 days. Well, ballparks?
Ballpark, yeah.
Okay. So if I start breeding them 21 or 30 days beforehand, how does that give me a level of improvement? And is 30 days enough? I'm going to pick on your 30 days.
Yeah. So honestly, when I was younger, I even recommended more, 40, 45 days. There's two problems with that is that just really extends your calving season. And now I'm talking about breeding heifers. So think about getting those heifers bred. Now they're really young. So I think that's pushing it too far. So my 30 is kind of a compromise between what is possible back when they were a heifer, about a year of age, and where I want them to be as they're finishing up as a 2-year-old. So I'm going to defend my 30 days because honestly, I'm not going to argue with Philip. I'll take anything. I think 20, 30 days is a pretty good place to start. But the one other thing that you haven't mentioned yet and that I want to focus on is that's when we'd start calving those heifers. I also am interested in when we're going to stop calving them. And I usually, if I can get enough, it's all about if I've developed those heifers well so that a high percentage of them do conceive in the first 20, 25 days, 30 days, I may limit the heifer breeding season to no more than 2 cycles, so 42 days. So I might start 30 days earlier than the cows, and that means that I'm only going 10 days or so into the cow breeding season, and then I stop with the heifer breeding season so that there are no heifers that are going to give birth mid to late in the subsequent calving season.
So you're correctly telling me that I asked the wrong question. And the question is not when should I start calving the heifers, but when should the last heifer calve relative to the cows, which is actually a way better question.
Yeah, so, and I think that's a great plan for what heifers you're going to keep in your herd. But I put a lot of resources into developing these heifers. So what if I go ahead and breed the rest of those heifers, let them get pregnant, and then I can either sell them as bred heifers because I know they're late bred, and based on getting my preg check done at the right time, I can tell which ones are late bred. Or I calve them out the next year and I sell them as pairs, or I sell them off or something. I got options there. But I've already got a lot of resources in developing those heifers. And to sell them as a feeder animal is taking a pretty big hit in most years.
Yeah, they're worth more as pregnant heifers. But I like the way that Bob framed it is you're looking at when are those last ones going to calve. And just because they got pregnant, they don't have to stay in my herd, which is what you're saying. So I can still set a cutoff of which ones I'm going to keep in my herd based on when they calve. And I would argue I may want to start 30 days before, but I may want to end calving the day before the calving season, which means I'm going to keep that hopefully 2/3 that get pregnant that first 30 days. I don't have a stretched out calving season. I still have them calving before the cows, and they're likely to get bred back the next year.
Once again, that was the Beef Cattle Institute's Brad White, Bob Larson, and Phillip Lancaster. If you'd like to hear this full Cattle Chat podcast episode, you can do so by following the link in today's show notes on agtoday.net or by searching for Cattle Chat on your favorite podcast platform. That's all we have for you today on Agriculture Today, but we'll be back with more for you tomorrow.